And here are the 3 charts that explain why Janet Yellen isn't raising rates until December. Ellen, talk us through your first one. It's looking at the labor markets conditions index. We seem to think, hey, labor markets are not doing too poorly. We're looking really good. What does this chart tell you?
Well, this labor market conditions index sort of wraps up the broad number of labor market indicators that Janet Yellen always cites that she needs to see improvement in. It's not just about the unemployment rate, it's about the share of part-time workers that wish they could work full-time but can't, discouraged workers, the gambit. And it wraps it all up into one neat index. And it did weaken in the later spring months. And that a lot of that was as we digested some of the layoffs in the mining sector because lower oil prices led to layoffs there. Manufacturing sector had a little bit of difficulties because of the rapid rise in the dollar. Some of the production was slowed or halted in certain areas. So we had to digest that, and the labor market conditions index declined. Now it's moved back into positive territory, so it is growing, but growing more slowly. Or it means the labor market is improving, but improving more slowly. This is critical for the Fed because the entire way they've framed monetary policy and their desire to lift rates is based on continued improvement in the labor market. So we follow that monthly conditions index closely to see that it stays in positive territory and at least shows, even if slow improvement, that it does continue to improve.
All right, you mentioned that the dollar was one factor. It was a drag. Talk more about that. We have a chart of the dollar. Why is that something you're paying close attention to?
Well, I think we can't harp enough on the dollar as a wild card for the Fed. Not only a wild card on when will they lift rates, but the dollar as a determinant on the pace of rate hikes after they do start raising rates. It causes a lot of indigestion to central bankers when their currencies have a rapid appreciation or depreciation. And what we saw from August through early March was an unbelievably rapid ascent of the U.S. dollar. It can be extremely disruptive, and net trade was our biggest drag on growth as a result in Q4 and Q1. So if the dollar continues to rise rapidly as a central banker, I can't have enough confidence in my outlook for growth to raise rates today. And so many policymakers have said they hope the bulk of the adjustment has been complete. So the bulk of that rise was markets adjusting leading up to the first rate hike. But we'll see. If the dollar's appreciation remains tame, then the Fed can have the confidence to move. If, as they get close to raising rates, the dollar takes off, it's going to lead to too much uncertainty, and they'll choose to delay.
And the last chart really has to do with the savings rate, consumers stashing their cash and not paying and spending. Talk to us about this.
So, starting with the April meeting of the Federal Open Market Committee, they spent a good deal of time talking about why is the consumer not spending. And what we found is that there's actually a lag time between the time that gas prices bottom, which they did in January, and the time that households start spending that savings. Because they have to be convinced that gas prices not only they see that they've fallen, they have to be convinced they will stay low. And it's about a 6-month lag. And so we are in that period, and we think consumers have started to pick up their spending. We've seen that, as I mentioned, Q2 spending tracking 2.9% versus 2.1% in the first quarter. So we think that consumers are spending more. The Fed will need to see more data. They'll need to see that July retail sales report, Joe, that we'll all be watching closely.
July.
Yeah, July. But that will tell them if consumers are going to continue to bring that personal savings rate down and spend more.